For the next several minutes, I'm going to touch base on our philosophy at Blue Haven, talk a little bit about that, and then talk about the problem of unnecessary secrecy in corporate governance, a challenge we face as investors, not just impact investors. My wife Liesl and I were both involved in impact investing before we met, but after we got married, we decided to reorganize our family office to focus on impact investing. For us, this means we are seeking to optimize the financial, social, and environmental performance of every investment we make across asset classes. We're going for the win-wins. It's not good enough to only go for market rate financial returns anymore. We want the companies and strategies that we invest in to deliver more to society than a liquidity event. Why are we doing this? Like many of you, we think it's a smarter way to do business. It's smarter for the long term. Taking a diversified approach that includes impact factors lowers volatility. It's investing with higher standards. And also, we have a 2-year-old, so it would be great if she could grow up in a planet that's habitable. So we literally are investing for future generations. We view impact investing as informed investing. We include a broad range of information that is material to making prudent investment decisions, and we want to know exactly what we own. Now, knowing what we own is easier on the private side of the portfolio. For example, we have a dedicated $50 million allocation to early-stage direct investments in fintech and renewables. There, we can get the company reporting we want. But as I mentioned, we have a diversified asset allocation. Where we run into more difficulty, ironically, is getting good enough information on the public side. Investors, not just impact investors, face an information imperative. And these days, we also face too much secrecy. Let's take climate risk. We know that the climate is changing. Near our home, there are plants, including wild blueberries, that bloom much earlier in the year than they used to. But that's about all the information on climate risk we get from looking out the window and walking around the house. The rest we need from scientists, policymakers, and companies themselves. At Blue Haven, we believe that climate risk is intrinsic to business risk. We know that. Luckily, more investors are starting to pressure companies for this, as you heard about earlier, but still not enough. So let's take a look at this recent snapshot from Bloomberg. It is on climate risk proposals, and it includes many disclosure proposals here. So this is basically showing what % of the 68 major climate proposals at companies last year investment managers supported. The good news, the chart represents some improvements. You have with certain funds, you have the percentage has increased over time. Let's see that the percentage votes in favor. I think this also includes State Street. The State Street numbers have actually improved to 46%, up from 2012. You see other asset managers here as well. And the problem, though, is that there's a lot of variation you can see. Like some are way up there at the top, and some are at 0. So what's up with that? Yeah, the improvements are not happening fast enough for the industry. We see substantial division in this space, with some firms not fulfilling their responsibility in today's world. This allows too many management teams to keep too many secrets about their risk profile, from mega investors, retail investors, and family offices alike. On climate change, we must thank our friends at investment firms for recent improvements, but we also must ask all of them, with the possible exception of Principal Financial and Deutsche Bank, which is also way up there. I think it's above Principal, to do better. Let's take a look at a related issue that is very relevant at the moment, corporate disclosure of political spending. At Blue Haven, one of the things we believe in firmly is that we need fair rules for an efficient market. And when large corporations try to game the system, everyone loses in the long term. But disclosure around political spending is not just a good thing to do for the market or society. It is integral at Blue Haven for helping us ask questions about how management views risk. So, for example, Lockheed Martin spent almost $13 million on lobbying last year, but why did Alphabet spend even more than that? What were they afraid of? Unfortunately, most companies still keep too many secrets, hiding their spending. We know, for example, that last year, $103 million was spent by the US Chamber of Commerce to influence politicians. But we actually still don't know which companies contributed through the chamber to what, for whom. It and other associations like pharma have become massive operations that hide donations from companies. And that is not a healthy thing for market capitalism. Wharton helps with an annual study of how much information S&P 500 companies disclose on political spending. It's called the CPA-Zicklin Index. I actually highly recommend you download it sometime and search through it. It's got lots of great material. Here are the number of companies that scored a 90 or higher out of 100 on a scale of 1 to 100. This group includes names that Blue Haven owns, like IBM, Microsoft, and Accenture. We can see the numbers rising from 23 to 35 in 1 year, but 35 is a still small fraction of the S&P 500. And just scoring a 90 or higher doesn't make your name a saint. It just means you're actually telling people how much effort you're putting into shaping market rules. Too many companies, including obvious ones that we don't own, such as Exxon, and ones we do, like Walmart, Kimberly-Clark, and Delta, are still afraid to release key information to their own investors on their efforts to influence politicians. And some are offering leadership the wrong way. Witness President Trump's astonishing Valentine to the culture of secrecy yesterday. For those who missed it, he just signed an executive order permitting U.S. oil and gas companies to keep secret their payments to foreign governments. Really. The good news is we may be trending in the right direction with the help of investors who are demanding more information, but we all could be doing more to demand more, not just from management teams at large companies and policymakers at the SEC, but also demand more from the leadership of the largest investment firms that are now best positioned to demand better information from the management teams that they invest in. Even as we love talking about the sexy stuff of investing in entrepreneurs, impact investors can challenge the financial industry to do much better on getting what should now be considered basic material information from C-suite management. If we don't pick up the pace on this, we face more inefficient markets for a long time to come. Let's remember that leading conservative and leading progressive economists don't agree on everything, but they do agree on the importance of better information for investors. They do agree that an economy built on an unnecessary secrecy leads to government nepotism and monopoly power and a less competitive economy. It will lead not just to more climate change and more pollution, but slower growth and a higher cost of doing business. That's why it's more important than ever that we keep the foot on the gas when it comes to insisting on more disclosure and not less. For us all to do well in the 21st century, remember the information imperative. In the face of challenges like climate change, noticing that blueberries are blooming early is nice, but obviously not enough. Today, the best investors are hungrier to understand the risk of the largest companies. The best investors are citizens of the market and stewards of our future and demand the information, the real facts, that we all deserve.
Thank you very much. I have just one question for you, and it's based actually on the slide that we won't ask for it back, that showed money managers and how they were voting on climate proposals. And it showed the likes of Vanguard, for example, basically not voting in favor at all. And there's a bit of a tension here, right? As money goes into passive investment, people are paying less, but the flip side of that is that money managers are not engaging as much, right? They're kind of paid to snooze a little bit. And so you're describing a bit, you want a world where people are more engaged, they're more active, money is flowing into passive, where the setup, the business model is kind of incentivizing a less engaged approach. How do you think about that tension?
Yeah, it doesn't really cost Vanguard much to vote against management when they're trying to keep secrecy. The costs are negligible. So the cost explanation really doesn't make sense. If they were trying to negotiate with management to do more, I can understand that. But even just their voting habits are pretty abysmal and it doesn't really cost much to vote.